Welcome back, everyone. You may be familiar with my 4-factor dividend growth strategy. If you're not, I have an entire playlist here on YouTube dedicated to covering this strategy. If you are familiar with this strategy, then you likely already know that the strategy has worked very good since it was launched in late 2022. Since launch, the portfolio where I deployed the strategy is up over 45%, giving it a CAGR of over 30%. That's pretty phenomenal, but without some context on how the overall market has performed, this figure is a bit meaningless. Relative to the market, measured by the return of the S&P 500, my strategy has a 4.81% higher CAGR, a pretty good level of outperformance. Relative to the popular dividend growth ETF, SCHD, my strategy has a 21.76% higher CAGR. I compare this strategy to SCHD because it was inspired by the process SCHD's underlying index uses to select its constituent stocks. Today, instead of talking about how the strategy is performing, I'd like to tell you why I believe it has worked out so well, and whether or not the same level of return can continue going forward. In order to understand why this strategy works, you need to know the two main steps this strategy uses to come up with its constituent stocks. The first step is coming up with the initial investable universe of stocks. And the second step is narrowing down the investable universe to just the top 20 stocks. Let me unpack these two steps a little more to give you a little bit more context. Coming up with an investable universe is a very important start to the stock selection process. Instead of scanning thousands of dividend stocks that are tradable in the market, it's much easier to work with a small and manageable list of companies. This step also lets me tailor which part of the market I would like to focus on. Take the Dow Jones US Dividend 100 Index, the index SCHE tracks. It starts with a universe of roughly 3,000 stocks, excluding REITs. Then it runs all of the stocks through a set of filters to come up with a more manageable list of stocks to choose from. The first set of filters screens for a history of consecutive dividend payments, a minimum float-adjusted market cap, and a minimum average daily volume traded. This tells us that the process looks for companies that have a commitment to paying dividends, are established businesses of a decent size, and their stocks have liquidity in the market. The stocks that pass this initial screener are then sorted by their forward dividend yield, and the bottom half of the list is eliminated. This tells us that the strategy focuses on finding an attractive dividend yield. And the final constituent selection process is based on how well the remaining stocks rank across 4 fundamental characteristics: the free cash flow to total debt ratio, the return on equity, the forward dividend yield, and the 5-year dividend growth rate. The process identifies the 100 best dividend stocks the index will hold for the next 12 months. There are a few more rules that allow prior constituent stocks to remain in the index, and some sector exposure limits that come into play. But the point is that the index has a clear set of rules it follows to update its constituent stocks each year. This process does not involve any person making any decisions, leaving all emotion and bias out. I like this simplicity. While the process itself may not be simple, because there's a few steps to follow and a lot of data to crunch, it is very clear which stocks are included and which aren't, with no backroom dart throwing to fill the last few spots in the index. So the US Dividend 100 Index steers its investable universe towards large, liquid companies with a commitment to paying dividends, and generally towards stocks that pay more generous dividend yields. My 4-factor strategy follows a similar process, but I steer my investable universe in a slightly different direction. My focus is more geared towards finding high-quality businesses. I use a set of characteristics in my screening process that, in my opinion, are associated with companies that are generally of higher quality, things like a growing revenue stream, and businesses that have economic moats. Step 2 is the stock selection process, and my strategy is very similar to that of the Dow Jones US Dividend 100 Index. I use the same 4 fundamental characteristics that I previously outlined for the index, with the exception of switching the return on equity with the return on capital. In my opinion, the return on capital is a more useful metric relative to the return on equity. I also don't have any of the additional rules from the index, like the maximum sector weights, or allowing prior constituent stocks to remain in the index. All I do is select the top 20 stocks identified by this process, and I buy and hold them for the next 12 months. Alright, now that you understand the process a little more, let's get back to the question at hand. Why does this strategy work, and can it continue working in the future? I believe the strategy works primarily because of its focus on finding quality companies when coming up with the investable universe. Quality companies generally perform in line or better than the average stock market return, especially when measured over longer periods of time. So by targeting companies that have a statistical probability to meet or exceed the stock market return, we increase our odds of achieving a solid rate of return. I think the investable universe is about 75% of the reason why this strategy works. The other 25% is the final stock ranking process that attempts to identify the handful of stocks within this investable universe that may potentially be more opportune investments at the moment relative to their counterparts. Let's look at some data so you can see how I came up with my assumptions. I took the June 2023 4-factor list, as it's the earliest list since I've started documenting the strategy each month, and I analyzed it to see how it has performed relative to the S&P 500. The investable universe in June of 2023 was made up of 134 individual companies, from which I selected the top 20 stocks for inclusion in the 4-factor DGR strategy. It's been nearly 10 months since I ran this process, so it gives us an almost full year of returns to analyze. Between June 1st, 2023 and March 25th, 2024, the S&P 500 is up 26.27%. The average return for all 134 stocks in the original investable universe is 26.66%, right in line with the return for the S&P. And the average return for the 20 chosen stocks by the strategy is 36.54%, a cool 10% more than the S&P 500. Here's a visual to show you where each stock and the averages fall on the return spectrum. The top 20 stocks that were selected for the portfolio are shown in yellow. The rest of the universe is shown in black. The red bar shows the average return for the top 20 stocks. The purple bar is the average return for the entire investable universe, both chosen and not chosen stocks. And the green bar is the return for the S&P 500. You can disregard the ticker symbols at the bottom, as they aren't lined up with the correct stock. I forgot to include them when sorting the data, and didn't feel like redoing the chart. What we can see here is that the return for the S&P 500 is about in the middle of the chart. It's a little off-center, tilted to the left towards the higher returns. Out of the 134 stocks in the investable universe, 63 have higher returns than the S&P 500, which means that 71 stocks have returns that are lower than the S&P. 11 of the chosen 20 stocks have returns that are higher than the S&P, and a few of these stocks are close to the far end of the high return spectrum in the chart. Ultimately, the goal for this strategy is to have the purple bar, the average return for the investable universe, to be relatively close or higher than the S&P 500 return, and to also have the red bar, the average return of the chosen 20 stocks, be higher than the return of the S&P 500. Clearly, the June 2023 top 20 list has thus far worked out great. Some of this can be attributed to Williams-Sonoma that is up a phenomenal 179%. But even if we exclude this single outlier, the remaining 19 chosen stocks have an average return of 29.01%, which would still place them ahead of the S&P 500. Some observations I've made while reviewing this strategy during the last 2 years is that the strategy works well when the market is up, and it tends to underperform when the market is down. This was somewhat expected, as the screening process focuses on quality and growth. And growth stocks generally run hotter when the market is moving up, but they also tend to take a bigger beating when the market is pulling back. I believe this strategy has the potential to deliver very good long-term returns, given that the market typically goes up more than it drops in the long run. But it will definitely take a few beatings when we find ourselves in the next market crash or correction. It's definitely geared more towards investors with a long-term outlook on the market, and ones that aren't too concerned with some short-term volatility. The fact that the investable universe return is relatively close to the S&P 500 return tells me that it's a very important factor in this strategy actually working well. To test how effective the ranking process is, I decided to test how a randomly chosen set of 20 stocks from this investable universe would have performed. I sorted all of the stocks in the investable universe in alphabetical order and assigned them a number from 1 to 134, and used a random number generator to select 20 numbers for me. I ran this number generator 5 times, giving me 5 unique sets of portfolios of 20 stocks. The returns these random portfolios generated are as follows: 40.99%, 27.55%, 22.13%, 27.1%, and 23.22%. So we have one great return, 2 returns that are better than the S&P 500, and 2 more that are still pretty decent, however slightly lower than the S&P 500. These results support my assumptions that the investable universe is a primary driver of the strong returns the strategy has been able to attain. The ranking process has its merits as well, and theoretically should contribute to the overall alpha in the future. The last 16 months have been a rather good time for the stock market, and while it's nice to enjoy a 30% CAGR, I don't believe the portfolio can sustain this level of return in the long run. Personally, I would be content with a 12% CAGR after 5 years, and I would like to see the same CAGR extend for the next few decades. I'm sure when we see the next market correction or crash, this strategy will underperform the S&P 500, and some of the early alpha it has accumulated will disappear. But in the long run, I believe this strategy has the potential to outperform the S&P 500. I hope you enjoyed the content. If you did, please do me a favor, give this video a like and subscribe to the channel. Thank you for watching and see you next time.